Okay, I'm assuming we are live. So good morning, everyone. My name is Joseph. I'm conference director at 100 Conferences, and I would like to welcome you to the second day of our 100 virtual DACH event. We would like to thank our partners, the speakers, and of course, all of the attendees. We hope you enjoyed the panel discussions yesterday, and we hope you will enjoy the upcoming presentation and discussions which are scheduled for later today. As I already did my part of talking, I would like to introduce Eric de Montgolfier, CEO of Invest Europe, to present to us some fresh data concerning private equity activity in the DACH region. Please feel free to ask your questions in the chat section on the right side, as Eric will take a couple of questions at the end. Eric, the stage is yours.
Thank you, Joseph. Good morning, everyone. First, allow me to thank 0100 Virtual DAR for its kind invitation and providing me the opportunity to speak about the challenges and opportunities within the DACH region. It is something I will do using the most comprehensive and authoritative source of European fundraising, investment and divestment data, our own, as supplied by Invest Europe's 550 plus members. Next slide, please. A quick word first on who we are and what we do. Invest Europe is the largest PE association in the world, bringing together over 550 members, GPs as well as LPs, with a good balance between our full members, 1/3 VC, 1/3 growth and buyouts, and 1/3 LPs, and a well-represented PE ecosystem with almost 100 associate members. With members located in 37 European countries, our association reflects the global nature of our industry, and it is an industry that at the end of 2019 was managing almost 710 billion euros of capital across Europe, including 258 billion euros of uncalled commitments, according to our recent report. Next slide, please. Reports are only as reliable and comprehensive as the data that feeds them. Invest Europe has been collecting data from its members since the 80s, first through the Private Analytics database, and then, as of 2007, through the European Data Cooperative, or EDC. The EDC collected the 2020 data from more than 1,600 active firms, including 117 with headquarters in the DACH region. And stringent audits ensure the best coverage and a consistent application of methodology and definition. The result is our first half and annual PE activity data reports, arguably Invest Europe's flagship publications. Next slide, please. Ahead of the release of our full report this Thursday on May 6th, which will also be distributed to you by the conference organizers, I'm delighted to share the DACH region findings, starting off with fundraising. I would highlight 3 key points from this slide. Over the last 5 years, GPs in the DACH region raised a total of 34 billion euros, divided by 17 billion in the buyout segment, 12 billion across venture, and 4 billion for growth funds. This, however, represents a mere 7% of the total 500 billion raised in Europe in the same period. In 2020, DACH fundraising was significantly less resilient in the pandemic than in other regions across Europe, down 24% versus 15% across Europe, including for VC down 29% versus minus 7% across Europe, down 57% for buyouts versus 23% across Europe. And for growth, a strong performance with a 2.1 billion euro raised, limiting the overall impact for the region. Next slide, please. Great. If we examine now the funds raised by region of management and investor type, we observe that proportionally, DACH GPs raise more funds from corporate investors, family offices, or government agencies, but less from pension funds, sovereign funds, insurance companies, or fund of funds when compared to the European average. which is, from our perspective, a strong indication that GPs headquartered in the region could attract far more money from institutional investors in the years to come, provided, obviously, they can generate the same or better returns than their non-DACH competitors. Next slide, please. When we move from fundraising to investments, we know that a total of 78 billion euros was invested in the region by PE and VC funds from 2016 to 2020, well above the amounts I mentioned earlier, 34 billion, raised by local and regional GPs. This signals the attractivity of the region and, in parallel, the high market share of non-DACH players, and therefore potential for local and regional GPs, if successful, to raise and invest larger funds in the future. If we look closely at where the money is coming from over the last 5 years, data which are not reflected on the slide, we see that by amount invested in DACH companies, only 28% of the investment amount is coming from GPs with an HQ in DACH, while 72% of the money is coming from non-DACH GPs who either have an office in the region but no headquarters, or do not even have an office at all in the region, which concerns 41% of the GPs. In 2020, from 470 GPs that have invested in the region, 204 had their headquarters in DACH, and the remainder, 266, i.e. 57% of the number of funds, are not headquartered in the region. From the number of portfolio companies invested in, it's of course a different story in terms of number of companies supported. GPs from DACH still support the vast majority of the 5,000 plus firms which were invested in. This also means that the largest transactions are mostly supported by GPs from outside the region. Last comment I would like to share, in 2020, investments resisted better than fundraising, down 14% versus 2019, even showing a 2% increase in the volume of companies backed by the industry versus the same vintage. This evolution is in line with the amount invested in European companies, which decreased 12% in 2020. Next slide, please. Now, breaking out investments by stage and region, we found that over the last 5 years, investment in the DACH region represented 19% of total invested in Europe, the third highest total by region, as well as 19% of European portfolio company invested in. Lastly, there is no significant difference in terms of split by stage when compared to the two largest regions in terms of investment. Next slide, please. It is important to place these figures in a wider context, that of all private equity investment as a percentage of GDP, based first on the location of the PE firm itself. And here, as you can see on the slide, the news is less compelling. In 2020, all 3 countries of the DACH region rank way below the European average in terms of investment made by the DACH GPs, expressed in percentage of GDP. Collectively, there is definitely room for growth. But let's move to the next slide. If we look at the same metric over 2020, but applied to the location of the portfolio company, the figures show that all 3 countries in DACH region rank closer, but still slightly below European average in terms of investment made into the local portfolio companies, expressed again in percentage of GDP. Non-DACH GPs help partially offset the gap versus Europe average, but it's still an area for significant growth, as you will no doubt agree. Next slide, please. Last but not least, our data shows that in the 2016 to 2020 period, a total of 26.4 billion euros was divested at cost across the DACH region. This means a total of over 3,200 companies were divested in the same period. Interestingly, it's not again reflected on this slide, divestment at cost in 2020 are down 14% from the year before at 3.5 billion euros, which is in sharp contrast with European figures, which were down 34%. That's a discrepancy we haven't explained yet, but we will look at it in the coming days before announcing our full report on Thursday. Next slide, please. The statistic previously presented highlight the economic impact of our industry, fundraising, investment, divestments, but do not give an indication of the social impact of PE and VC-backed companies across and outside the region. Invest Europe has long known of the need to develop a data-led overview of private equity social impact across Europe. We simply did not have the hard facts until September 2020, when we released a groundbreaking report entitled Private Equity at Work, presenting a transparent account of European private equity's record on employment and job creation for the first time. It revealed that 10.5 million people were employed by private equity across Europe in 2018, creating jobs at 5 times the average rate. Today, I'm proud to share with you the preliminary result ranges for the DACH region from the second edition of the same report due later this month. They show that PE job growth in the 2018-2019 period across the region was between 4% and 5%, with some 30,000 to 35,000 new PE-backed jobs being created. Again, this was around 5 times the average market job growth rate. The result, some 1.6 to 1.7 million PE-backed jobs across the region. More can be done, as these represent only between 3.2 and 3.5% of the DACH workforce versus a percentage of 4.5% registered across Europe. If we look now at the national charts, we see that Austria was in the lead in terms of job creation growth, followed by Germany and Switzerland. Last slide, please. In conclusion, although the DACH region harbors the strongest and largest European economy, Germany, as well as experienced GPs across all stages, all our data point in the same direction. There is scope for improvement, sometimes huge improvement, when compared to the European average and the largest and more mature regions across Europe for private equity and venture capital. The potential of private equity can be carried forward in the DACH region, even during these most challenging times. The industry is continuing to support businesses and the long-term investors whose money we manage. Companies that can emerge from this downturn stronger will be able to continue to create jobs, generate returns that support pensioners in retirement, and contribute to the European economic recovery. Thank you for your attention, and I will now leave the floor open for any question you may have.
Okay, so thank you very much for an interesting presentation, Eric. We are honored that you were able to share this first data with our audience. And yeah, I guess it looks that the DACH region is profiting from the private equity activity in the region, comparing, to other markets, I would say. And yeah, as you said, we can take maybe 1 or 2 questions, as we are slowly running out of time. So let me just see in the Q&A section. Is there any specific reason the fundraising activity dropped more in comparison with other European regions? Do you have maybe some insight on that?
Well, we have some insights, but nothing that we can put our finger on specifically at this juncture. We need to analyze more specifically the data we have in terms of what are actually the firms that have been backed in their fundraising during that period. I think there are 2 main explanations. One maybe is that there were less fundraising that started before the beginning of the pandemic, which means that as LPs slowed down the process of looking at new funds, the ones that hadn't started before 2020 were actually hindered from raising funds significantly during that period. So the early movers of 2019 were probably the firms that were privileged in that very specific, in these very challenging times. The second explanation I see is that, as you've seen, there are in the DACH region a lot of non-DACH-based or DACH-headquartered firms that may have raised funds for specifically Germany outside the ones that we capture with this data. Meaning that some, for instance, a UK-based large brand name could have raised funds devoted to continental Europe, including, obviously, part of that money devoted to Germany. So looking at fundraising only with the prism, the focus on GPs headquartered in the DACH region doesn't probably reflect the full amount of money which has been raised with the objective of having it invested in Germany.
Okay, I guess that makes sense, I guess. Okay, maybe a last one, quick. What is the appetite of LPs in DACH region investing into first-time fund managers in the region? I guess maybe some first-time manager is trying to find out which LPs he needs to talk to.
Well, it's a good question and a good reason to ask it, obviously. What I think is in the current period, and that's I would say the feedback we got from a number of LPs that are members of the association, there was a clear focus on brand names, on teams that were already well known by LPs and that were looking for money in 2020. Why? Because when it comes to doing due diligence, it's easier when you've already met a team, when you understand the strategy, when you've been exposed possibly as an LP into one earlier funds, to understand the rationale of the new fundraising and be able actually to look at the data that had been provided from a desktop, I would say, a perspective, which is very difficult when you're starting a new relationship with an emerging manager, because you have a track record which is not as easy to read, and the dimension of meeting the people, visiting offices, getting a sense of what the strategy that will be pursued is, can't be summed up only in figures provided in a track record table. So it's not the easiest moment to raise a fund when you're emerging manager, but all LPs are well aware that in the top decile of the best performing fund of the last 10 to 15 years, there's always been emerging managers that have come across that bar and been extremely successful, which means that the door is always open to meet virtually at this juncture, but patience is probably requested.
Okay, so I guess our first-time fund manager got some interesting advice as well. Patience is the key. Okay, so I guess we would need to finish now. So thank you once again, Eric. Very interesting presentation. As mentioned in the chat, we will share the full report with the audience later this week. So stay tuned for the emails after the conference. And yeah, thank you once again, and hope to see you maybe next time with another set of fresh data.
With pleasure. Thank you, Joseph.
Thank you. Bye-bye.
Bye.